Monday, the 25th of September. It's ugly out there. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So one of my team earlier on today said to me, happy Monday, which I don't think is a thing. And it's certainly not a thing today when it comes to financial markets. Look at what is happening out there. Stock 600 down by 1%. Luxury stocks are getting dinged up pretty badly. The miners are getting dinged up pretty badly. Travel and leisure stocks, more the leisure than the travel, getting dinged up pretty badly. Stock 600, 448. Getting through some technical levels in Europe as well, which is pretty ugly too. Entain. This is what I mean about the travel and leisure sector, down 14.5% today. The outlook, not good. This market is having to take this company is having to take a look at its markets and review where it goes next. That stock getting hurt pretty hard. Look at Kering. Paris Fashion Week is underway. Apparently it's going quite well. Apparently the Kering show was great, but you've got a Bank of America downgrade today, which is knocking the stuffing out of that stock, down by 4.5%. You've also got Valentino out, the CEO of Valentino making some pretty negative comments as well about what is happening in the luxury space. So, Kaylee, happy Monday? Not really.
Yeah, it doesn't really seem like a happy Monday here in the U.S. either, Guy, because you are seeing selling in the equity market, and that probably has a lot to do with the selling we are seeing in the bond market. Right now, the S&P 500 off by about 0.25%. We're at the 43.08 level, but it really is the 10-year yield that captures our attention, maybe following really what we saw start in Europe overnight. But that yield now up 8 basis points on the day. We're at 451. This is a fresh high since going back to October of 2007, almost 16 full years. What's interesting is it is concentrated in that long end of the curve. At the front end, you really aren't seeing much movement at all. We are flat on the day on the 2-year, which is just at 5.1%. And finally, this is feeding through into a stronger U.S. dollar as well. The Bloomberg dollar index up by about 0.5% on the day. And at 12.63, we are now at the highest level going back to December of last year, Guy.
Well, let's talk about what is happening over here in Europe, because apparently we're responsible for all of this. I want to talk about what's happening with the German bond market, the bubble and the shafts, what's happening with real yields as well. Are we going to 3% on a German 10-year? Well, certainly, if you take a look at the activity and the move that we've seen over the last couple of days, maybe the momentum is taking us in that direction. I think we've got 9-year highs on real yields. Germany is stagnating right now. The economic data is not good. People are talking about Germany being the sick man of Europe, yet what is happening here is potentially higher inflation and lower growth coinciding. That is not a great combination. And maybe that's ultimately what is being priced into the German 10-year, Kaylee.
Yeah, and it all is going to come down to how the ECB reacts to a potentially stagflationary environment. ECB President Christine Lagarde was just speaking before the European Parliament in Brussels, and she reiterated that borrowing costs will remain elevated for as long as needed to tame inflation.
Our mission, our duty is to return inflation back to target in a timely manner. The faster it gets there, the more stable prices are, the less painful it will be going forward for both those who invest, but also those who have borrowed.
As Torsten Slot was saying in his note earlier from Apollo, stagflation looks like the real story here in Europe, and the playbook is a fairly straightforward one from central banks. You have to keep interest rates higher, and at some point you hope that there is a spark that reignites growth. Why are yields higher, though, I think is a key question, and I think that's a question we need to answer. I think it probably is a cocktail of factors, but some may be more important than others. So why are yields higher, and which yields are more important in this whole story? Joining us now, Bloomberg's Justina Lee and Eddie van der Volts. Justine, I'm going to talk to you first, because I want to pin you down on what you think the answer is to what is happening here. What do you think is driving yields higher? Is it a cocktail of factors? Is it the oil price? Is it central banks? What do you think is going on?
Well, it seems like investors are slowly adjusting to the reality that rates will stay higher for longer. And of course, last week we also got some noise from Fed officials saying that there might even be one more rate hike coming up. And I think sort of the catalyst for all that is that move in oil higher. Now, a lot of that narrative has been more about the supply side than the demand side. So it's not necessarily having to do with inflationary pressures increasing that much. But I think at the very least, it's pretty direct. You know, you have higher oil prices, that translates into a faster inflation in terms of the headline numbers.
Yeah.
But what's so interesting, Eddie, and I'll let you chime in here, is this idea that it's not break-evens that have been driving any of the moves that we're seeing, which is where you usually would see oil showing up. It's a real yield thing. So what's your take on this?
Yeah. I think that Justina was absolutely right just there. This is a story about higher for longer is here to stay. The market's buying into that. I think we're seeing real changes in the market's assumptions about just how long inflation is going to be with us. And then, if you see inflation that sticky, you don't want to be anywhere near the long end. And if we're going to get this benign bear steepening, I say benign is not benign for the bond market, obviously, but which the market says, look, we're going to probably see bear steepening. If we see that, we see 200 basis points, that's going to have to come quick, in the next sort of 12 months. And I think there's a lot of pain underlying that, particularly for the bond market, particularly for pension funds and so on. But I do think that, this it seems to be the outlook. To your question about whether, why we're not seeing this in break-evens, I think, the break-even market, I think that is a much more illiquid market than people assume. I don't think it is as good at forecasting inflation as people assume.
So you're firmly of the view that this is an inflation, this is underlying, this move we're seeing in the bond market has its genesis in inflation. It's not supply and demand. It's not QT. It's not what's happening with the strikes and the fact that ultimately we are seeing a potentially longer-term shift in labour. It's not what is happening in terms of the European story versus the US. So it is fundamentally driven by inflation.
Guy, I think all of the above, right? I think we've got a bunch of narratives driving us, all in one direction. I don't, the QT debate, I'll leave for others, but I do think that, wages, I think people's inflation expectations have shifted. They're going to, we're going to talk about strikes. This stagflationary debate that you're talking about, it is becoming entrenched. It pops up from time to time, but I've never really had as many mainstream investors and economists talk to me about, about stagflation. So it feels like that is here to stay.
And to go back, Justina, to what ultimately stagflation is going to mean for the ECB, as we just heard Christine Lagarde saying that they're going to stay high until they absolutely have to, until inflation comes low enough that they're comfortable. Who's going to be able to hold higher for the longer period of time? Can Europe do it, or is that going to be the Fed?
Yeah, it's kind of interesting because on the one hand, you have Christine Lagarde trying to send that hawkish message, or at least tell investors that we want to keep rates high. But you're already hearing a bit of divergence from other ECB officials saying that maybe the European economy can't take this for much longer. And I think you're already seeing that in the European numbers. And, Europe has always been like a more cyclical economy, and so it's more exposed to, slower Chinese growth. Of course, that also depends on what we're going to see out of China. But it would seem like for now, I mean, the ECB probably kind of will have to relent earlier.
Do you think that the central banks are happy with what is happening in the bond market, though? Because in some ways, they've made it very clear. And Christine Lagarde was talking about it again today. We are not talking about cuts. So what is finally happening in the bond market now is an acceptance that the cuts are not coming. The cost of that is higher yields, which is going to have an impact on growth. But do you think fundamentally central banks are ticking the box here and saying, yep, I think our communication strategy has worked?
I think they're probably happy with the self-fulfilling prospects of it, in the sense that they don't want investors to think that, we're going to cut rates next year. And that hopefully has the effect of, preventing inflationary expectations from becoming entrenched. But of course, you can say that, once borrowing costs go up enough, it does make it harder to kind of pull off a soft landing, which a lot of Fed officials were still hoping for. I mean, at this point, are we still going to get that?
Well, to the point on the soft landing, we just had a headline crossing from S&P, now expecting the U.S. economy to expand 2.3% this year. Their previous view was 1.7%, so it just speaks to the resilience that we've seen that maybe took many people by surprise. And Eddie, what that has come with as well is pretty surprising resilience of the U.S. dollar. We're back at the highest levels we have seen year to date since December of 2022. What do you make of that?
Yeah, look, I spoke to a lot of investors over the last week or so about, where do you position for stagflation? If this is your base case, if you believe that not only are we going to see stagflation, we're going to see protracted stagflation. And they all said, look, the dollar is the place to be because the dollar, the Fed has the most room to maneuver here. I think that the Fed has created some space for itself in order to react, whereas the ECB, their situation's tough. And I think just the fragmentation of Europe still is a risk factor. So I do think, investors in any time of panic will flow to the dollar.
Is the fact that yields are going higher just an example of the market getting everything wrong again? So we thought there were going to be cuts, so we were wrong. So now we're sending yields higher. And I'm now wondering whether the fact that yields are higher and we're all pricing in this higher for longer basically signals that actually we are right at the point at which the economic story falls out of bed in a fairly big way. Europe already is. The United States probably could be next. To Justina's point, starts to become self-fulfilling. It's hard to pull off the soft landing. We're pricing in higher yields because the economy is proving resilient. But the fact that we're doing that probably means that it won't be.
Yeah, and look, I think, you've got to accept that if you're going to get bear steepening, there's going to be pain. And if we're not going to get a steepening via the front end of the curve, where the Fed is forced into cutting, then I think there's going to be pain for some. But I think that probably that narrative is one of less economic pain and growth returning at the same time as inflation remains high and perhaps a secondary or a second acceleration of inflation. I do wonder, though, whether the Fed and other central banks will make the transitory mistake again. I think this time around they will pull the brakes fairly hard if inflation starts getting away from them.
All right, Eddie Vanderwalt from our MLive team and Bloomberg's Justina Lee, thank you both very much for joining us. Coming up, we're going to have more on our question of the day. Why are yields higher? Emmanuel Cao, Barclays head of European equity strategy, is going to join us next. This is Bloomberg.
Once summer's over, that first cold snap starts to hit, there's probably going to be a big global oil producer who suddenly decides that they don't have the supply they thought they had, the price needs to go up. And I think we need to stop being surprised by that. Looking at a world where Russia's at war with Ukraine, I think that we're going to see them have a lot of supply issues in the winter that really, drives up the price whether we like it or not. And that does have an impact on yield.
Sarah Kurtz, Managing Director, Clio Capital, speaking to Kaylee and I a little bit earlier on. Her stab at the question of the day, why are yields higher? She's certainly pointing us in the direction of oil prices. Let's get another go at this question. Barclays Managing Director, Head of European Equity Strategy is, of course, Emmanuel Cao. He joins us now. Emmanuel, this is not your wheelhouse, but it seems to be impacting what you do. Yields are higher. Why do you think they're higher?
Well, we think they're higher because the markets are listening to the central banks and to the big one. I think the Fed somewhat wanted the market to listen to her last week, and the Fed has been forcing a hawkish repricing in rates. Now, if you understand the rationale for the Fed to be hawkish, it was largely because the Fed has been revising up growth projections. So, today compared to 1 week ago, we have from the Fed forecast of higher growth in the US next year and lower unemployment. So that's why the Fed has been, making a point to convey the message that rates have to be higher for longer if growth is stronger for longer. And I guess, higher growth should come with higher inflation. So look, we are running around in circle here. We have been debating this for most of the past 12 months now. And look, at the end of the day, there is no free lunch. If growth is strong, you should expect inflation to stay resilient and central banks to have to maintain a very restrictive policy as long as necessary.
Okay, so if that's the case, if we are going to live in a higher for longer for world and borrowing costs are just going to be higher, that would put pressure on at least certain pockets of both the U.S. and European equity market. What is it going to do just in terms of the relative attraction of what you can get in the bond market versus the yield offered by equities?
Clearly, the bond market is becoming much more attractive to us. And we've been quite cautious as a house on duration on bonds, but now, we pretty much had a 40, 50 basis point repricing on the short end of the curve in the last couple of weeks. So clearly the bond market is reflecting now a much more reasonable outcome in terms of policy, inflation, and growth. So yes, we find more and more value in fixed income. Now, I guess what will dictate the direction of travel for the equity market is whether the economy, whether earnings can stay resilient in the environment of higher interest rates, which is what we have seen so far this year, or do we start to see something breaking? Do we start to see higher interest rate hurting the economy? So I think, I'm not sure the market is going to give it the benefit of the doubt because, as we know, most of the past tightening cycle ended in tears and hurt the economy, hence the equity market at the end. But what we've seen so far is basically equities being able to shrug off the threat of higher rates because earnings have been quite strong. So I think the Q3 earnings season will be quite important as the next catalyst for the market.
Emmanuel, the PMIs are clearly showing weakness. The PMIs, even on the services side, are starting to show that Europe is struggling. Companies have been able to keep their margins looking good, as you've just been talking about, because the top line has been strong. Do you think the top line will be able to continue to be as strong? Where does the pain start? Where should we be looking for? Is it at that top line? Is it in margins? Where do you think in the next earnings season we should be looking?
But PMIs have been a very misleading indicator of the cycle so far because I think they failed to capture the impact, the benefit of higher inflation on top line and earnings. Earnings have been quite resilient for pretty much the past 12 months, despite PMIs going down. So I think, as long as we have, inflation relatively high, that should come with a bit of cushion to kind of top line and earnings for the corporate sector. I think, what the market will be looking for is any kind of sign of demand pressure in some end markets. We've seen manufacturing being pretty soft already, but we've seen, again, that a very strong consumer, very strong services. So do we start to see cracks in consumer market, whether it's in Europe or in the US? That's something I think the market is going to watch. And then I think, do we start to see companies or consumers talking about not being able to pay the debt? Do we have some credit issues that start to hurt margins and profitability?
To the idea, though, of potentially starting to see some cracks in demand on the part of the consumer, are you worried at all about luxury, Emmanuel?
We do. We've been worried for some time. So we've been, I think, trying to find a balance in portfolio. We still want to have some risk in some cases, but we don't want to overpay for risk. So we try to combine cheapness or low valuation that can basically, give us a bit of a hedge against higher interest rate and low earnings expectation. That's why we like the financials and we like the commodities. They are cheap and we think earnings prospects are quite positive. On the other hand, we are much more nervous on the expensive cyclical sector, which are still on very high valuation, have a bit of long duration bias, but also have earnings risk if things go wrong. So we've been reducing we cut already luxury good in March, but our analysts were turned more cautious on some of the prominent names in luxury a couple of weeks ago. We are bearish on industrials. We've been cutting tech in August as well. So we want to have a bit of a balance in terms of cyclicality, but what we are much more focused on in the valuation and how much we have to pay to express earnings risk or views.
LVMH is down 20% from its peak. I guess a case in point. Emmanuel, let's just talk about between now and year end. Is cash going to be the king between here and year end? What do I need to do to outperform cash if I want to be in the equity market?
Well, it's going to be very hard to beat cash risk adjusted, but a lot of the clients who speak to institutions cannot be 100% cash. They still need to invest in a world where cash is a very competitive asset. So within the equity market, we think you want to be in, cheap stock sectors which have an earnings catalyst, hence the commodities, the miners, maybe the banks, the financials. That's what we like. We also want to have sector which can generate significant cash flow. We think healthcare is a good one, for example. And on the other end, we don't want to be in expensive, long-duration sectors which have an earnings risk in case growth were to be slowing. Now, if I look at the different regions, of course, US is a safe haven. So very hard to see money going back into Europe without any kind of, sense of inflation peaking or Chinese growth, going back up or picking up again. But I would just flag that the valuation of the US market and this very stretched, crowded consensus tech part of the market looks a bit vulnerable to a more sustained repricing higher in interest rates. So, hard to see Europe outperforming the US if we are stuck in this deflation. But from a relative positioning standpoint, valuation, we see Europe offer some interesting balance against what is a very US-centric global equity market.
All right, Emmanuel Cao, Barclays Managing Director and Head of European Equity Strategy. Thank you so much for joining us. This is Bloomberg.
The American market is slowing down due to the reality that department stores are really in a suffering situation at the moment, plus the reality that spending is slowing down. The expectation that China will come into the market in a big way after the closure that they have suffered from in the last 2 years is not happening.
Rashid Mohammed Rashid, the chair of Valentino, the founder of the Alzra Investment Group, talking to Bloomberg a little bit earlier on today, basically mirroring what is being said across the whole of the luxury space at the moment, Kayleigh. You've heard it from Richemont, you've heard it from all kinds of places, even LVMH, which is down 20% from peak to trough, talking about the weakness they are now seeing. Richemont talking about it being a 10-year unwind of excess that is going to take years to come. And I tell you what else is really digging up the sector as well today. Those comments from Valentino certainly having an impact as well. But a note out from Bank of America, which has had quite a big impact on Kering today, having a really big impact. Bank of America downgrading that business on its consumer profile. It doesn't see it as quite as high end, so it sees it as being more exposed to this consumer slowdown that we're seeing. That is a street low price target of 430 euros on Kering. I'm told, Kayleigh, that the Gucci show, the new Gucci show, went very well at Paris Fashion Week. You cannot see that being reflected, though, in what is happening with the stock market right now.
Yeah, I guess it's a question of how good is a good collection if you don't have people who have the spending power in order to purchase those items. And that really is what this concern comes down to, Guy. After so long of seeing resilience in consumption, are those cracks starting to emerge, and how is that going to weigh on those names, not just in terms of the European consumer base or the U.S. one as well, but as Bank of America is pointing to, China?
China's a big factor in all of this. None of these engines are firing, and I think that's the big problem. Yeah. And the more exposed you are further down the income scale, that gets worse and worse and worse. I do wonder, though, whether or not, if we see a stock market rout, whether that starts to affect the upper-end consumer as well, which has thus far been much more resilient in this whole process. So I think the financial market feedback loop into all of this really quite significant. Kering, the luxury sector, all under pressure. The close is coming next. This is Bloomberg. It's a Monday, it's a holiday, but it still feels like important things are happening. The European bond market story, the global bond market story, is a significant narrative that feels like it hasn't really rippled fully yet out into other asset classes. Yields are climbing and climbing fast, particularly at the long end, which is fascinating. European equities are under pressure today. The FTSE's down by 0.8%. Similar for the CAC. DAX is down over 1%. Series of big sectors are under pressure today. Luxury's down. Travel and leisure's down. It's more of the leisure than the travel. You've got the big mining stocks are all really under pressure as well. All of this coming together to produce really quite a negative session. Now, volume has picked up as the day, a bit of a lag in volume midday, is beginning to pick up a little bit now, which I think is interesting as well. Keep an eye on that volume narrative. Are we starting to see a pickup in volatility as well, which could make this into an even more interesting week? Kind of feels like interesting things are going to happen. You've got a lot going on, a lot of factors coming together. Want to talk about Airbus a little bit, a stock that I pay quite a bit of attention to. Fantastic team here at Bloomberg monitoring what is happening there. Looks like, according to those guys telling me this, we could potentially see a big Airbus order coming through this evening, 350s. We think it could be coming out of Air France. We're going to wait, we're going to watch, we're going to see what happens there. But also significantly, watch for news on management reshuffle. I think the FT had this story earlier on. Maybe going back to the kind of Tom Enders-Bregier kind of model with Faury and Scherer at Airbus, maybe making it a little bit more manageable in terms of management bandwidth. Anyway, keep an eye on Airbus. That stock down by 0.8%. Kering is being battered today by that Bank of America downgrade, really under significant pressure. Despite the fact that the show at Gucci, apparently I'm told, I don't know about these things, was quite good, but nevertheless, that stock coming down quite hard. Rio Tinto, I mentioned the miners, look at it, down by 2%. That's the China story. That's what's happening with Evergrande. All of this coming together, everything seems to be coming together right now. That's just Monday. We've got a rest of a week to get through as well. Let's talk about what we're going to be looking about for the next few days. Rate decision out of Hungary. I'm going to be going Tuesday, maybe Wednesday, actually more of an important day to the World Aviation Festival. That's taking place in Lisbon. What's happening with the airlines and the demand story? We're going to be talking a lot about that. Got the Spanish PM vote, Prime Minister's vote on Wednesday. Thursday, we get into the CPIs. This is where I think it gets interesting from Europe. Spain, Germany, CPI, Eurozone data out Friday. What is that CPI data going to tell us? Christine Lagarde, very clear today, talking about the idea. She ain't talking about cuts just yet. The lady is not for turning when it comes to the rate path right now. Let's talk about how important, therefore, this CPI data is going to be for the markets and what messages it's going to bring. Sebastian Wismara, financial economist at Bank of New York Mellon, joining me now on set. Nice to see you.
Nice to see you.
CPI end of the week. Lagarde's making it very clear that rates are going to stay up. They're going to stay there for a while. What is the CPI going to tell us about whether or not she's going to actually be able to achieve that?
Well, the CPI is going to be pretty important, as you've mentioned. Ultimately, the message of higher for longer is going to have to be validated by the data. The CPI indeed is the data that investors will look at for the euro area, given the single mandate of the ECB. We don't expect a particular large surprise either way. We think that this inflation process is in place in the euro area for the coming months, but for this one in particular, we don't expect a large surprise. So more to come over the coming months in terms of ECB news.
Well, and Sebastian, as we think about what higher for longer actually means, for how long do you think the ECB is going to be able to keep rates high? This is where a recession forecast, I would think, comes into play, unless you think the ECB is going to be willing to tolerate that because of the inflation fight.
Well, our view is that rates will remain high until at least the second half of 2024, despite the fact that we see inflation coming down towards 2%. The economy has weakened, but inflation remains high, and it remains much higher than target. So the ECB is trying to manage that growth risk in the context of inflation that remains pretty elevated. And again, it's a central bank that has a single mandate on inflation. So we think the ECB will be biased in terms of cutting later than other central banks, if anything.
Is this stagflation? Are we there yet on the stagflation debates? Torsten Schlock at Apollo, I keep bringing this up, is basically saying this is where Europe is now. And in reality, what that means is that the central bank playbook is fairly straightforward. You just have to keep rates higher. And at some point, you've got to hope there's a spark that ignites growth. But you have to deal with the inflation story, and you have to deal with it in a fairly clear and decisive way. And in many ways, that mirrors what Lagarde was saying today. It's too painful. We have to get it down. That is our job.
I think that's right, unfortunately. I think ultimately the ECB will manage risks that way and will probably tend to over-tighten the economy. So at the moment, the economy it is in a sort of stagflation environment where growth is very low.
Yep.
I mean, the basis from where it starts, the euro area is a lack of growth, and inflation remains high. Disinflation is in process, but it's still too high for the ECB to relax. And that, to me and to us, means that they will keep rates too elevated for long until growth deteriorates more and more sharply.
Earlier, Sebastian, our question of the day was why exactly yields are higher. And we had a whole conversation about how oil and energy is factoring into that. How do you think the ECB is looking at the energy picture, given how problematic it has been for Europe specifically?
Well, energy is an interesting story. Traditionally, central banks tend to look through these type of energy shocks. However, I think we're in a different situation at the moment. Again, the starting the starting level of inflation matters quite a bit. And what also matters is that inflation expectations tend to be fairly correlated with energy prices. So the ECB will be looking at this particular shock with a hawkish lens. Again, it's another shock that contributes to the idea that they will remain, they will keep rates for high.
Do you think they're feeling validated right now? Rates are going up. They want to make clear that the message that they're trying to get across is that we are not going to be cutting. Lagarde spelling it out time and time again. She's trying to. She doesn't want to pause to turn into pricing of cuts. Do you think the central bank is feeling that their communication is working, and the way they can see it's working is because yields are going up and going up across the curve?
Yeah, I mean, the fact that yields are rising, it's tightening financial conditions, which is in line with the message that central banks, broadly speaking, around the world, particularly in developed markets, are trying to deliver to the market. The ECB obviously doesn't want an excessive tightening of financial conditions, but I think the moves that we've seen are in line with the message they provided. Obviously, there are other news around the world. The Fed has provided a hawkish message to the market, and I think part of the moves, even in Europe, are driven by what we've seen in the US.
Great to see you. Thanks for stopping by to see us. Interesting week coming up. Sebastian Wismara, financial economist, joining us at Bank of New York Mellon. European stocks done for the day. We're off the lows. Little tick higher during the auction, but we are still finishing firmly in negative territory, as you can see. Let's call it down circa 1%. I'm being maybe a little bit too negative, but the DAX certainly down by that kind of an amount. The inflation narrative, certainly a big factor in what we're seeing with yields right now. Oil playing its part. Are we heading for 100? There is but one person to ask this question. We head now back to the 2023 American Energy Security Summit that is taking place in Oklahoma City. There is, to be found there, one Alex Steele. She is joined now by Continental Resources President and CEO. Alex.
I have to say, I'm having a lot of fun. It is a lot of fun talking to everybody here. That's right. Doug Lawler is Continental Resources President and CEO. He's promised me an interview like, 8 years ago, I think. He's finally making good on that, so I appreciate that. All right, Doug, let's just start off with Continental now being private. You're not constrained by the public market. Does that mean you're just going to go pump everything there is to pump at Continental?
That's a great question, Alex. It's a great thing being a private company. No, it does not mean that.
Okay.
We are investing at a very prudent level, consistent with our cash flows. Just to go and invest and be producing as much as we can is not how we generate the greatest value for. We still have owners, we still have shareholders. We're interested in investing at a pace which creates the greatest amount of value. Being free from a lot of the public market constraints gives us the ability to think about value and how do we grow value for the long term.
So at $100, do we think we get to $100 oil? And does that change how Doug looks at things?
I think we absolutely will. I think we're going to continue to see volatility in the $80 to $100 oil price environment right now. But I think the higher price is a reality that we're going to have to deal with as we think about our investments and we think about the energy needs of the globe. And the fact that we know today that it's being more broadly recognized that oil and gas is going to play a key role in our sources of energy in that energy stack over time, as projected.
So help me understand then. So the idea is that you guys want policy to be supportive of oil and gas because we need it in the energy transition. But then you're still going to be capital disciplined and do things in a smart way. So what gives? Like, what's the problem then? If we're keeping it, production's almost near a record high, and you're still producing a bunch in near records in the Bakken, what's the problem?
So the key today is I don't think that there's a broad enough recognition that this is a depleting resource. We still have a very strong need for oil and gas to power the energy needs of the entire globe. Mm-hmm. And we know by all the projections, whether they be government or whether they be by industry or research associations, that oil and gas is going to play a significant role, greater than 50% oil and gas specifically, all the way through 2050 and beyond. The problem we have, and what we need to be most concerned about, and we don't get enough attention on, is there's been a fundamental lack of investment in the last 10 years in exploration. Mm-hmm. And so when you talk about mobilizing resources and bringing more oil and gas to production, we're fairly balanced today, and that's good. The market's fairly balanced. But what we're not doing in a depleting resource is investing enough in exploration. for future energy needs.
So what I'm hearing from you is that it's not so much you need permission to drill, you need permission to explore. That like because productivity has become a problem in U.S. shale, you're not going to keep getting more and more out of the asset. You have to keep pumping just to keep production flat. Is that a fair assessment?
It is a fair assessment, but being able to have the permits to drill for exploration are very, very important in the United States onshore in the shale areas.
For federal lands, which is where that's been an issue before. But you guys are the tech guys. I mean, you're pioneers. You're like the shale cowboys, you know? Like you have your cowboy hat and you do cool tech stuff that gets more oil out of rock. Is that underselling your ability to keep doing that?
No, not at all. We will continue to innovate and improve in using technology. The horizontal drilling, as you know well and have heard so much about here recently with Harold's book and Game Changer, you know, the industry's made huge advances there. We're also seeing now where the average lateral length in horizontal shales has been 2 miles. Now we're going to 3 and looking at 4. So those are things that are going to continue to provide an opportunity for good investment and good production. But the key is that there's been underinvestment in exploration. And if we don't start thinking more about exploration and that investment here in the U.S. and globally, this depleting resource is going to be a challenge and will result in higher prices.
So let's go to the laterals for a second. So for non-oil nerds who are listening, it just means like how long you're going to drill this way underground. 3 to 4 miles, that's a long way. There's like a lot of technical risk that can happen with that. Like you mess up one thing, it's huge.
Yeah.
I mean, is the risk really worth the reward on that?
It is, because what it's doing is it's enabling us to access additional rock that we can actually stimulate and produce. So instead of, you know, we're vertically developing in most of the oil and gas plays in the U.S. reservoirs that range from 10 to call it 14,000 feet, just on average. And then we'll actually turn and go horizontally another 2 miles, and now looking to extend that.
Which also brings me to cost. That's got to be really expensive. Like that's more horsepower, that's more casing for your tubing and all that kind of stuff. What's expensive right now for you guys? Like what's going to be sticky costs for Doug Lawler?
So we obviously have seen increases in costs associated with inflation, services, labor, but we also, the steel, water, sand, all the kind of raw elements that go into our drilling and development programs have been higher, and it's going to be a constant challenge. And you know, when you think about these costs, it is not inexpensive to bring energy to market, and significant risk, as you described, is taken.
And how much of that's sticky?
I think that it's all fairly sticky when you say, you know, the kind of term sticky. I mean, do we see opportunities with technology to continue to improve our costs? But a lot of what's taken place here in the past few years, we're seeing it to be a little bit more resistant than what we would have liked, and being able to claw back some of those inflationary gains that we were recognizing.
So, okay, if you're here, you're going to make a pitch for we need clearer, more consistent policy to be able to explore, to get the oil, so we don't have volatile prices between 80 and 100 plus. What is that policy? What about the people who are going to say, yeah, but then you're just going to pollute the environment? Like, you're not going to help us. Does that mean you have to go full on in carbon management then to kind of sell that story?
Well, the oil and gas industry has made tremendous progress with respect to Scope 1, Scope 2, and pushing to Scope 3. We're also doing things here in the near term, looking for how we can help other industries, how we can do things in the agriculture space, in the retail space. We are going to continue to make improvements there, and it's just not fully recognized what oil and gas is doing for our total energy needs of the United States, and how we're working so hard to improve the environment. Natural gas, calling a bridge fuel, a transition fuel, has made a huge difference in reducing the carbon and the reliance on coal in the United States. It has to continue globally.
For the IRA, Inflation Reduction Act, what do you like in that? What do you hate in that?
I dislike anything that discourages continued investment.
But does it do that?
Well, it doesn't. There isn't anything in there that's helping to incentivize our continued development. And just again, as I had highlighted, the fact that we are not recognizing that energy, our sources of energy, are going to include oil and gas for the long term. We need to be investing more in exploration. This depleting resource is critical and essential to our everyday life.
If we don't hear your message, if the politicians don't hear your message, what happens to the oil price? Like, are we going to 150 again? Like, what's going to happen?
Instead of seeing $80 to $100, you're going to see 120 to 150.
Ooh, Okay, so back 2008, that kind of scenario.
Well, it's going to be, it ties back to, as we have been talking about, the Permian Basin has been a tremendous growth basin for the oil and gas business here domestically, but also a great impact globally because of that supply that's been mobilized there. The Eagle Ford, the Bakken, other strong oil-producing shale basins in the United States, they've reached their peak. The Permian Basin will reach its peak also, and when that happens, that's going to send a shock through the system that the United States can no longer grow a major basin. And when that happens, without encouragement and good policy towards energy investment, the opportunity where companies will invest in exploration, you're going to see more pressure on price.
Doug, it was worth the wait. Look, I appreciate it. Thanks very much.
So great to see you.
Doug Lawler,
Thank you.
CEO and President of Continental Resources. Guys, back to you.
All right, thanks very much to both Doug and Bloomberg's Alex Steele. And of course, Alex is going to be back for more later today. She has a one-on-one interview with Republican presidential candidate Nikki Haley. So don't miss that at 1:30 p.m. New York time. You can also follow it on Live Go on your terminal. But what you can get right here coming up next, we're going to take a look at the health of commercial real estate. Mark Gibson Jones, Lang LaSalle, Capital Markets America's CEO, joins next for Money Undercover. This is Bloomberg. We turn now to this week's Money Undercover for valuable insight into alternative investments. We'll get an inside look into the world of private debt, private equity, and real estate. Here's Lisa Abramowitz now with Mark Gibson, Jones Lang LaSalle, Capital Markets America's CEO. Lisa.
Thank you so much, Kaylee. We originally started Money Undercover before the pandemic to take a look at some of the areas that were less transparent in capital markets, that were just attracting so much money. And now we take a look at those areas that are still attracting quite a bit of money, and quite a bit of notice in some other ways. Joining us now is someone who can answer some questions that people keep raising about, in particular, commercial real estate at a moment where people are wondering, what is the next shoe to drop? Could it be this one? Mark Gibson joins, Jones Lang LaSalle, Capital Markets America's CEO. I want to start there, Mark. I mean, you've heard all of these discussions about how commercial real estate is the next shoe to drop. Do you think that that is an accurate description of the tsunami of potential defaults that could be hanging out there?
Lisa, thanks for the question. I don't, simply because commercial real estate, like every asset class, adjusts to the cost of capital. And as a result, just given the Fed's fight against inflation and the cost of short-term capital increasing at a very rapid pace, everyone has had to step back and reassess values and deal with what every industry is dealing with. So we don't see this tsunami of defaults and issues in commercial real estate as is being portrayed, primarily because most of the investors in commercial real estate have been conservative in their capital constructs, and they are beginning to think about a little bit higher for normal and adjusting accordingly. You will have tactical.
Wait, hold on a second, Mark. And I'll let you continue in 1 second. But the way that you're talking about it, readjustments and valuations, the real estate doom loop is how the Wall Street Journal just described it. And we're looking at office REITs falling the most since 2020. We're looking at yields that are pricing out a lot of people from the real estate market, with the transactions falling off a cliff. Is this a market right now that is functional, or would you say that this is sort of a broken market in terms of price discovery when it comes to some of the loans and transacting?
I think anytime is a great question. I think anytime you get a rapid increase in the cost of capital, you have what we call a bid-ask gap. So you have both sellers and buyers trying to figure out who is right. So do they believe that the cost of capital will continue to increase, or do they believe we will normalize at a different level? And therefore, if you're a seller, you're going to believe the latter, and if you're a buyer, you're going to believe the former. And the question is, they generally need more data for a period of time to determine, well, what is an accurate cost of capital? Where do we see it going? And for today, in today's world, what we're counseling people is just take a breath and think about, why are we where we are? and the common enemy is inflation. Do you believe the Fed will conquer inflation? Most long-term investors do. And the only debate is time. So once that occurs, then what is the risk we're underwriting? And most of these long investors are beginning to discount inflation risk and really focus on recession risk, because historically, that is what happens when you have such a rapid increase in rate moves. So there is a normal bid-ask gap pause. So transactional volumes in the U.S. are down 60% in commercial real estate, and that is normal. But we're beginning to see that change, particularly as people adjust to the cost of capital and we have rationalization of pricing. So we're beginning to see transactional volume inch up as a result of that.
What about in office real estate in particular, given the fact that it's not just inflation, it's also the idea that occupancy is dramatically lower than where it was pre-pandemic?
Occupancy, we could spend an hour talking about occupancy in office buildings, but the narrative is going to change significantly in our view over the next 12 months, which is work from work will be the new mantra. And we're beginning to see that take place across every industry in commercial real estate. And the primary driver for that is falling labor productivity across every industry. And the need for training, the need for collaboration and teamwork and culture is really beginning to take precedent in every industry, again, across the United States. So we think the narrative on office is going to be considerably better in the next 12 months, but there is going to be a vast stratification of values across the office sector. And what I mean by that are buildings that have been constructed over the last 10 years or so are going to get preference in terms of occupier interest. Meaning tenancy interest and where they go. So there are going to be quite a few haves and have-nots in the office sector and commercial real estate.
Mark, just quickly here, we only have about a minute left, and I'm wondering how far you think we are in this downdraft, particularly in the office space area, which is down, I believe, about 30%, even in less liquid markets. How much further do we have to go?
One never knows. So it depends on the cost of capital, where we see the inflation risk, Lisa, there. But I would tell you from our perspective and where we're seeing the market react in terms of actual transactions taking place. We just announced a fairly large trade in New York. There are many more that are happening. Our belief is that we are at bottom. From an office valuation perspective, it's a very general statement. As we stated earlier, there are going to be significant have and have-nots. But generally speaking, I think the office sector has found a bottom level.
Mark Gibson, thank you so much for spending the time with us at a time where everyone is wondering what is going to be the ramifications, particularly for banks that own a lot of real estate. Thanks again. Over to you, Guy. Thanks so much.
Great stuff, Lisa. Thank you very much indeed. Lisa Aroundwitz. Catch Money Undercover, same time Mondays, here on Bloomberg Television. What have we got coming up next? The AWS CEO is going to be joining Bloomberg Technology. Caroline Hyde and Ed Ludlow next. This is Bloomberg.